it sounds, tell me if I'm wrong, but the way Mike just described it could have come out of your mouth, right? This glass half full thesis.
Well, in one sense, Carl, I mean, I've been saying the economy is, doing well. Consumer is driving the economy. Unemployment is low. Wages are rising. Savings are increasing. So as a result of all of those things, I expect the consumer to continue to drive the economy.
Despite a slowdown in hiring, despite some waffling in confidence, despite market volatility, yeah?
Well, all those things are present, but there's always something to worry about. The key things are unemployment is at a record low, and it has, a 60-year low, I think. And consumer incomes are strong, and anybody who wants a job can get one. The biggest problem our portfolio companies are having is hiring good workers. So as long as that's the case, the economy is going to go on and continue to grow. Remember, when you talk about a slowdown, you're talking about a slowdown of growth, but it's still growth. There's still growth around the world. It may only be 1%, but it isn't a contraction.
Jim, the same set of observations, I think, are being used by folks who say, well, that's kind of how things look when the cycle is getting toward an end, right? It's not necessarily people disagreeing about the facts on the ground. And here we have a Federal Reserve that has, I guess, portrayed what it's up to as trying to sustain that expansion. How's it doing?
It's overdoing, Mike. I think that the greatest threat to the world, to pick up what Sarah was discussing, is fake interest rates, is the systematic manipulation of the most important price in capitalism. And it is not natural state of affairs that there are some numbers of trillion, the number varies by the day, of securities priced to yield less than nothing in nominal terms. This is the most extraordinary fact, and we've gotten so used to it. We've gotten rather jaded to it. But, in this great repurchase agreement kerfuffle in the past 3 days, I mean, doesn't it feel a little bit like the gasoline lines of yesteryear? There's something wrong with the way the market's working, and that's something, it seems to me, has to do with regulation and with suppression of market forces. When the federal funds rate was free to move, it was supple and it balanced supply and demand, but there was this new regime in the past 10 years having to do with the interest on excess reserves, a topic probably better suited to print than video. But this recondite business of fixing a rate and then kind of bribing the banks not to put their funds into the market, this is contributing to these seemingly anomalous, but in fact probably well-grounded in theory, disruptions to the world of short-term rates.
There were some yesterday, Byron, who said the repo squeeze was not a good look. At the very least, not a good look for Powell on Fed Day.
Yeah, I mean, my feeling is there's too much liquidity out there. I mean, the problems weren't created over the last few days. I don't think cutting the federal funds rate 25 or 50 basis points is going to do any good. I mean, interest rates are already low. Anybody who wants to borrow can already borrow cheaply. The problem has been created over the last decade. We've created the central banks of the world. The Federal Reserve, European Central Bank, Bank of England, Bank of Japan have created $13 trillion worth of money. And they're going back to monetary accommodation again. They're trying to keep a recession from occurring by flooding the world with liquidity. European Central Bank is going to do it too. And what they're doing is holding back the dawn. They're trying to keep economies growing at some rate to prevent the next recession. At some point, it won't work, but it looks like it's going to work for the next year or so.
For the next year or so?
Yeah.
What happens in a year, then?
Well, I don't know. We'll have to see. You'll have to invite me back.
Oh, we're definitely doing that.
Yeah. No, but my view, I mean, a lot of people are worried about a recession in 2020. I don't think that's going to occur. Donald Trump doesn't want to run for re-election in a recession year. But after that, at some point after that, I think the economy is vulnerable. You can only push the recession out so far.
Jim, if this kind of repo eruption that we've had is a symptom of these kind of engineered efforts to try and, as you say, kind of keep liquidity in certain places and prevent it from going into others, and it's a little bit of a rupture. Is it not just, though, something that can be dialed back? I mean, the portrayal here is of, you can kind of adjust some valves and levers of the system, and you can release some of the liquidity back where it belongs.
I think in part that's true. The Fed can certainly institute a more or less permanent repurchase facility that will. But I think the greater question is who's in control? Is it the authorities, as we call them, central banks, or is it events? We have been led to believe the central banks are in charge, but I think Byron almost said, and certainly I took away from his talk, that events might get the upper hand. And I think, look at the action in oil on Monday and then the unscripted repo eruption on Tuesday and Wednesday.